Welcome to The Deep Dive, where we break down the most important sources to give you the insights that matter. Today, we are really getting into the Q3 FY2025 results for Flowers Foods. You know them, Dave's Killer Bread, Nature's Own, all those brands. The results dropped November 6th with the call the next morning.
And this is such a critical one to watch. I mean, Flowers Foods is in the middle of this massive, massive shift.
Two big forces hitting them at once.
Exactly. You have their core business, fresh packaged bread, which is in this, structural decline, especially that classic white loaf. And at the same time, they're trying to digest this huge, almost $800 million acquisition of Simple Mills. That's supposed to be their future.
So the big question for everyone listening to that call was, did these numbers confirm the pain, or did they, actually validate this whole pivot?
That's the billion-dollar question.
Okay, so let's jump right into the headline numbers then. What did we see on the bottom line?
Well, the adjusted EPS came in at $0.23.
Right on the money.
Precisely in line with what analysts were expecting. So, no major blow up there. The market probably breathed a little sigh of relief initially.
Avoided that big after-hours drop.
Right. But when you look at the top line, the revenue, that's where the story gets a lot more, let's say, complicated.
Okay.
Net sales landed at $1.227 billion. It was a tiny miss against the $1.23 billion consensus, but it still looked like 3.0% year-over-year growth.
Looked like growth. I sense a but coming.
A very big but. Because of that 3.0% growth, it was almost completely inorganic.
Meaning it wasn't their main business finding new life?
Not at all. The Simple Mills acquisition, which just closed this year, it contributed a massive 5.9 percentage points to that growth number.
Whoa. So if you take that out, the numbers go negative.
You got it. If you strip that out, the core legacy business is actually shrinking. You're looking at a negative price mix of negative 2.3%.
Meaning they're discounting or selling cheaper stuff.
Yes. And on top of that, a volume decline of negative 0.6%. So they're selling less and for less money. The whole revenue growth story is basically just Simple Mills.
So as an investor, I'm looking at that and thinking, okay, they're losing pricing power and selling less of their main product at the same time. That feels like a really bad combination.
It's the core concern. It really is. It shows that the legacy business is just fighting this really tough battle, and the acquisition is papering over some of those cracks for now.
All right, let's move past the headlines then and get into the real pressure points. I'm talking about profitability, the balance sheet. This is the deep dive.
And this is where it gets pretty ugly, honestly. The margin story is, it's tough.
They're trying to transform, but it's costing them.
It is. Gross margin, if you exclude D&A, it fell 190 basis points year over year, came in at 47.9%.
190 basis points. That's a huge drop for a consumer staples company, isn't it?
It's massive. And it's coming from a few different places. It's a bit of a triple threat.
Okay, what are they?
First, you've got pressure from product mix. They're selling more of the low margin stuff. Second, higher costs from outside purchases. And third, and this is key, Simple Mills itself just has a lower gross margin profile right now.
So the thing that's driving all their revenue growth is also hurting their profitability.
And the short term, yes. And that's how you end up with adjusted EBITDA margin dropping 160 basis points down to 9.6%.
The number that really jumped out at me was the GAAP EPS. We talk about adjusted, but the GAAP number fell 39% year over year to 19 cents. You can't just ignore a gap that big.
You absolutely cannot. The GAAP number tells you the real story, the true cost of this whole transformation. It includes all the one-time charges, the integration costs, all of it.
It's the painful reality.
It's a screaming indicator of just how financially difficult this pivot is.
And a big part of that difficulty has to be the debt. That $795 million for Simple Mills added a lot of risk to the balance sheet.
For sure. I mean, Simple Mills added a nice $70.7 million in sales and $11.1 million to adjusted EBITDA. But it was about a penny dilutive to adjusted EPS.
Dilutive. Let's break that down. Does that mean the business itself isn't making money, or is it just the cost of the debt they used to buy it?
That's the crucial distinction. It's the second one. It's the debt. They funded this thing with a ton of debt, and the interest expense is what's eating into the earnings per share.
And that's pushed their leverage up.
Way up. Net debt to trailing 12-month adjusted EBITDA is now sitting at about 3.4 times.
Oof. 3.4. For a staples business, that feels really high. Management said they want to get back to a more normalized ratio.
They have to. I mean, that 3.4x is a flashing red light for the market. A stable company like this wants to be under 2.5x, maybe even lower.
So financial discipline is priority number one now.
It has to be, especially with everyone talking about the dividend. The payout ratio is over 100%. The balance sheet is now in the driver's seat, period.
Okay, so that covers the financial pain. Let's flip it and talk about the strategy. How are they fighting back? This is all about winning in those little growth pockets and getting away from the boring stuff.
Right, and they have to fight because the backdrop is just brutal. Total bread units down almost 3%. But the traditional loaf category, their bread and butter, that plummeted 6.3%.
People just aren't buying it like they used to.
No, the consumer's shifting. They want better for you, protein, specialty stuff.
And it's impressive they're not just sitting there. They're actually winning in some of these new areas. Like in premium and specialty loaf, their units grew 4%, while the whole category actually shrank by 4%.
That is pure market share theft. It's all about their premium brands like Dave's Killer Bread and Canyon Bakehouse.
DKB is a powerhouse.
It really is. DKB units grew 10%. They're gaining share. They're fundamentally changing their portfolio, and it's working in those spots.
And the small loaves category, I mean, that number is just wild. Units up 85%.
85%. It's explosive. And Flowers jumped right in, captured 15 points of share, and became the number 2 player just like that.
What's driving that? Is it just smaller households?
It's portion control, it's value, it's less food waste. It's a really smart read on where the consumer is today. It shows they can be agile.
And they're not stopping at bread. They're taking that DKB brand and pushing it into snacking.
Yeah, the platform expansion is everything for the long-term story. The DKB organic snack bars, the protein bars, they're doing well.
And they've got more coming.
A lot more. A national rollout of DKB snack bites, 10 new snack stews, a whole breakfast bar platform. And, the Simple Mills integration seems to be going well too. Their crackers and cookies are up big, 14% and 23% in the channels we can see.
So they have a plan that seems to be working, at least in spots. Let's look forward now. What did they say about guidance, and what are the signals they're sending from the top?
They tightened up the full-year guidance for 2025, nudged the midpoint of sales up just a tiny bit, which tells you they're confident Simple Mills will deliver.
But what about earnings?
The adjusted EPS guidance, $1.02 to $1.08, that was basically unchanged at the midpoint.
Which means they expect that margin pressure to stick around for the rest of the year.
Exactly. The costs are real, and they aren't going away overnight.
And they're tightening their belts, too. I saw they cut the capital expenditure guidance.
Yep, cut it to $120 to $130 million. That's a real tangible sign that they are laser focused on generating cash and paying down that debt.
Which brings us to the big news, the CFO transition.
This is a huge deal. Longtime CFO Steve Kinsey's retiring. Anthony Scaglione is coming in this January. And you don't make a change like this unless you're serious.
What's his background? What does he bring?
His track record is all about leading big, difficult financial transformations. He's the guy you bring in when you need to clean up the balance sheet and instill serious discipline.
So this is a clear signal.
The massive signal that the mandate is deleveraging, cost-cutting, and getting that debt profile healthy, even if it means making some tough choices.
Okay, let's connect all these dots. Why should an investor who's maybe looking at tech or something faster growing even care about a packaged bread company right now?
Because the entire story has changed. This used to be your classic, stable dividend bread company, boring but safe.
A defensive play.
Exactly. Now, because of the debt and the decline in their core business, it's a levered, transforming staples platform. It's a turnaround story.
Management wants you to focus on the turnaround part, the DKB growth, the innovation.
Of course. But the market. Look at the stock. It's down 53% in the last year. The sector ETF is down, 3%?
That is a massive underperformance. The market is not buying the story yet.
Not at all. The market is just staring at that 3.4x debt load, the compressing margins, and that dividend payout. The whole thing boils down to a race against time.
Can the strategy work fast enough before the balance sheet forces their hand?
That is the entire ball game right there.
Okay, that is the perfect setup for our final segment. And a reminder to everyone, this is just our analysis of the call. It is not financial advice. Please do your own research.
All right, so let's game this out. An outrageous but, plausible trade idea based on that tension we just talked about.
Let's hear it.
We know the debt is high at 3.4x. We know management has to get it down. And we know a new CFO with a reputation for being a hawk is coming in.
And the market right now seems to think the dividend is safe.
I think so. The market is betting they'll slowly grow their way out of this mess over a couple of years.
But you're thinking the new CFO might not be that patient.
Exactly. If his mandate is to fix the balance sheet now, what's the fastest, most effective tool in his toolbox?
A deep dividend cut.
A deep, decisive dividend cut. It would be painful for current shareholders, no doubt, but for the long-term health of the company, it's probably the right move.
And you think that would cause a final capitulation? The dividend investors all run for the exits.
It would trigger a massive sell-off.
Yeah.
Which brings us to the trade.
Okay.
You could initiate a short position in the stock. Or, for a more defined risk play, you could buy some deep out-of-the-money put options. Maybe something like the $9 strike puts that expire in mid-2026.
So you're betting that the new CFO comes in, cuts the dividend to accelerate deleveraging, the stock tanks towards those lower analyst targets around $10.
And your trade pays off. And just as importantly, it creates a much cleaner, much more attractive entry point for long-term investors who actually believe in the DKB and Simple Mills growth story once the balance sheet risk is off the table.
It's a bet on financial discipline winning out over short-term sentiment.
That's the thesis.
Okay, so to wrap up this deep dive on Flowers Foods, adjusted EPS was fine, but the real story is the margin pressure from their transformation and acquisition costs.
Right.
They're fighting back hard, and they're winning in premium bread and snacking. The strategy is there.
The strategy is clear. But the final question for you, the listener, is the one we keep coming back to. Do you believe they can stabilize those margins and pay down that debt before the pressure on that dividend forces them to make a move?
The timing of that decision is everything.
That's the critical tension to watch as we head into 2026.
Answering that will tell you everything you need to know about this stock. Thanks for joining us, and we will catch you on the next deep dive.